Check, check, testing 1, 2, 3. Give me a test, please. See if you can hear me. Check, check, 1, 2, 3. Okay. All right, we are back on. A little bit of technical difficulty that happens. Is somebody looking at the relative volume? Can somebody tell me what the relative volume for today is, please? And thank you. All right, I finally got things back together. All righty. Test. Todd, Megan, you're back in the building. Thank you, buddy, for your patience. Dr. J, thank you for rejoining us. Raven Andrews, good morning and happy trading. Thank you. Dollar Bills back in the building. And Dan, the man, is in the building. Alrighty, hope everybody had a great, fantastic weekend as we get back to the business here on Monday. This magnificent Monday. Definitely going to be taking our time today, as I am really leaning more towards the afternoon trading, guys. Allowing the market to really settle down, pick a side, trick everyone else who it wants to trick, and then give us a clearer path to some profits. So I'm definitely going to be observing, but I'm not going to be heavy on the commentary because there's not really a whole lot to say. Very thin volume. Okay. Nice, beautiful view of that 5-minute chart. Go ahead and clear up everything else. I had a bug where I had to restart everything right in the middle. I think I must have left my computer on for too long. Today and today only, the daily chart and the weekly chart will mimic each other. So far, we're showing indecision, nice size doji. Minute chart showing a doji as well. Top left is the 1 minute. I'm gonna go ahead and switch that until the 2 minute. We're not ready to enter a trade right now, and I'm going to switch it to the Heikin-Ashi so I can observe the flow. And it's here in the Heikin-Ashi where you can see very easily that nice controlled buying structure. Higher highs, higher lows, higher highs, higher lows. But once we reach market open, we've had a little bit of chop. And just now, as I started speaking, have the bulls really start to assert themselves as they came to the bottom of the buying algo, and there they found support and are now back over VWAP. At 606.4 is a daily area of resistance, but still an area of resistance nonetheless. We have FOMC this Wednesday as well. And just that fast, the 10 o'clock candle is approaching in less than 4 minutes. We got a report come out at 9:45. So I guess that's why we had that volume spike. Okay. Again, I'm using Market Watch, what our teammates had brought to my attention, and this is what let me know that we had a report coming out at 9:45. However, it's never really the report. It's always a response to the news. We got a little spike in volume. But just like that, right back into the algo, Dan the Man says. And that's exactly what is happening. So I'm going to go ahead and blow up this 5-minute chart. Just so we can get a much bigger view. The largest volume candle that we had was the very first candle. The very first candle was the largest volume candle that we've had, with a lot of orders going off at 9:30. So guys, I'm here, but I'm gonna be in the background just in case. Let me show you my trading view algo before we go there. Here I have a larger selling algo that we're into, and right now this morning we are at the top of it. We did get above it, but we are back into it. So this is a much larger selling algo that is at hand. And I'm sure you can understand why we have a much larger algo, selling algo. And all you have to do is go to the daily chart to see that the last 3 out of 4 days have been red days. And that's why the market right now is in a larger controlled selling algo. I repeat, a larger controlled selling algo. We still have today upon us to see what today may bring. But I just wanted to explain where that was coming from. right, back to blowing up the 5-minute chart. Unless that be sufficient for now. Very nice gap up from Friday's close of 604 to where we are currently now at 606.50. Very nice gap up. Very solid move by the Bulls right here. A very solid move by the Bulls. Very solid move. Broke out and above VWAP, stood on VWAP, retested VWAP, put in a hammer candle, and now we're having a washout long effect. Ciabatta dip setting up. If anybody has any suggestions, trading plans, or any weekend jokes that they like to share, feel free to put them in the chat. We have plenty of time.
Let me show you why I stopped paying for all my other sample libraries. This is
almost ready to cut on the audiobook. For real. potential 3-bar setup. There's a lot of time left in this 5-minute candle though. It'll go both ways. But again, still acting within the algo, so all of this is still controlled. That's where we are currently. So I'm taking the pre-market out of the way, and hopefully get some volume. So I'm gonna keep up Fridays and todays. Friday chart and today's chart. We made some good money Friday. Alrighty, that's 11 o'clock. Thank you guys for tuning in. As always, I'm going to keep the chart up to date just so I can see if there's anything that may take place this afternoon. But I will be back looking around 1, 2 o'clock. Possibly back on the mic at that time as well. Chat is still open. Feel free to communicate. See you guys soon. I'm going to go ahead and put on the audio book. Let me know if anyone objects.
Can see how I am scanning real time for my momentum strategy. During the day, the scanner is finding stocks that have high relative volume, low float, and high activity. I then check them in my trading platform and decide, based on my momentum strategy set out in Chapter 7, if I want to trade them. Real-time reversal scanners top and bottom reversal strategy is another type of strategy that you cannot find stocks for in the pre-market. You must have an intraday real-time scanner. Here is an image of a top and bottom reversal scan, my intraday real-time reversal scanner. As you can see, I am scanning the market real-time to find stocks that are selling off or surging up so I can trade my reversal strategies. You can read more about these strategies in Chapter 7. I won't go into the details here about how to make these scans, but I will explain in Chapter 7 under each strategy the specifics of what to look for in stocks in each category. If you develop new strategies for yourself, you can define new scanners for yourself. These scanners are highly adjustable and you can change the parameters as you like. These are the parameters that work for me, but as you gain experience and learn more about other strategies and your trading style, you may very well decide to define new scanners for yourself. Many new traders don't initially need a scanner. If you join a community of day traders such as www.vancouver-traders.com, you will be able to see my scanner in real time. These scanners are costly, around $100 per month, so at the beginning of your career transition to day trading, you will probably want to keep your expenses down as much as possible. Planning the trade based on scanners. Once I find my daily alpha predators, the stocks that are independent of the overall market, I start to look for the individual setups in them. I constantly monitor their charts and try to plan a trade based on the strategies detailed in Chapter 7. I usually select 3 alpha predators and watch them separately on my 3 monitors. When I see a potential strategy, I plan my trade. This is a fast decision-making process. Sometimes you have to plan a trade in a few minutes, and at other times, in just a few seconds. This is why you need months of training in simulator accounts to well understand the decision-making process. I focus considerably on quality versus quantity. There are millions of traders out there, and there are no doubt millions of strategies out there as well. I had to find the strategy that worked best for me, my personality, and my account size. I found a strategy that works really well for my students as well as for my own personal trading. This strategy involves taking only the best setups and waiting on the sidelines until I see something worth trading. Day trading can be a boring profession. Most of the time you are just sitting and watching your list. In fact, if day trading is not boring for you, then you are probably overtrading. If you require a reminder of the importance of patience in trading, here it is. There are plenty of traders out there who are making the error of overtrading. Overtrading can mean trading 20, 30, 40, or even 60 times a day. If you do that, your broker will love you. You'll be commissioning them to do all of those trades, so you are going to lose both money and commissions. Many brokers charge $4.95 for each trade, so for 40 trades, you will end up paying $200 per day to your broker. That is a lot. Remember, your goal is to trade well, not to trade often. Another problem with overtrading is risk. While you're in a trade, you're exposed to risk, and that's a place you don't want to be unless you have proven that there is a setup in the strategy worth trading. Here is my next golden rule. Rule 8. Experienced traders are like guerrilla soldiers. They jump out at just the right time, take their profit, and get out. The stock market is controlled by machines and highly sophisticated algorithms, and, as a result, there is considerable high-frequency trading. High-frequency trading creates significant noise in the price action and is specifically designed to shake out retail traders like you and me. You must be smart. Don't expose yourself to them. Profitable traders usually make only 2 or 3 trades each day. They then cash out and enjoy the rest of their day. Chapter 5. My tools and platforms. Like starting any other business and profession, to start day trading, you require a few important tools. You need a broker and an order execution platform. These are tools you will definitely need for yourself. As explained in Chapter 4, you will also need a stock scanner to find your watch list and look for potential real-time setups. You may not need a scanner though if you are part of a trading community. People who are part of our community in www.vancouver-traders.com can see my screen in real time and use my scanners. What broker to use? For day trading, you need an awesome broker. You don't need a good broker, you need an awesome broker. Your broker is your vehicle to trade. If you have a bad broker, you lose money, even if you are trading properly and accurately, because a broker eventually has to fill your order on time and at a good price. There are many brokers out there with various software and price structures. Many of them are great but expensive, some are terrible but cheap, and many of them are either terrible or expensive or both. For the sake of keeping this book short, I will not start reviewing all of them, but I do have additional information on my website about brokers and which ones to choose. If you visit my website, you will have access to that information. I will share here though what broker I am using and why. For several good reasons, I am currently using Interactive Brokers or IB, www.interactivebrokers.com. First, I live in Vancouver, Canada, and IB allows me to have my tax-free and registered retirement accounts for day trading. Many brokers do not allow you to have tax-free or retirement accounts for day trading. Second, IB is an inexpensive broker. It charges you less than $1 per trade. Another reason I am with IB is because IB does not require people in Canada to have a minimum of $25,000 for day trading. If you are in the USA, you will probably need a minimum of $25,000 for day trading. You can read further about the pattern day trade regulation online. Do remember that brokers will give you 3 to 6 times leverage. If you put in $30,000, you're going to have $120,000 in buying power, a leverage of 4:1 in this case. That leverage is called the margin, and you're allowed to trade on margin, but you need to be responsible about it. It is easy to buy on margin, but it is also very easy to lose on margin. If you lose on margin, your broker takes the loss from your main money account. Therefore, margin is a double-edged sword. It provides you an opportunity to buy more, but it also exposes you to more risk. There is nothing wrong with buying in margin, but you do have to be responsible. Margin is like a mortgage for your house. You borrow a significant amount of money and buy a residence. Banks will give you a mortgage, but they won't take any responsibility or risk on it. For example, imagine that you put $100,000 down and borrowed $900,000 on a mortgage, 10:1 leverage, from your bank to buy a $1 million house. If the price of your house goes up to $1,200,000, you still owe the bank the original $900,000 plus their interest. So the extra $200,000 is your own profit that actually came from margin leverage. You couldn't have bought that house without mortgage leveraging. Now imagine that the price of the house drops to $900,000. You still owe the bank $900,000 plus their interest, so the drop has hit your main $100,000, and you have lost all of your original down payment of $100,000. That is the other side of leveraging. Therefore, you need to be responsible about when and how much you use your account margin. When a broker sees that you are using leverage and losing money, they might issue a margin call to you. A margin call is a serious warning, and day traders must avoid getting them. It means that your loss is now equal to the original money you had in your account. You must add more money, or else your broker will freeze your account. If you need to know more about margin, leverage, or margin calls, check the broker's website, do some research on the internet, or ask me or other traders in our private chat room at www.vancouver-traders.com. Trading platform and market data fast trade execution is the key for day trader success. You need to be able to move in and out of trades quickly. If your broker doesn't use a software or platform that has hotkeys, you're not going to get in and out of trades fast enough. I can't tell you how many times I've been up $1,000 because all of a sudden the stock spikes. When stock spikes, you want to be able to put money in your pocket and profit from it quickly. You definitely don't want to be fumbling with your orders. You need quick executions, which is why I highly recommend a good broker and a fast order execution platform. I use DAS Trader, www.dastrader.com, as my trading platform. DAS systems provide one of the most efficient execution solutions for online brokers, institutional trading desks, and traders worldwide that demand smarter execution services. On a literally 24/7 basis, I have found their support team incredibly helpful and competent. DAS servers are co-located with NASDAQ data centers. You cannot be any closer to the market for trading than this. DAS Trader is not a broker, but you can link your trading account to its platform for fast order execution. Some brokers will offer you the DAS platform when you open an account, but IB has its own platform that I do not recommend. I have a subscription to DAS and they have linked my IB account to the DAS platform. Watch list and scanner. I talk to new traders almost every single day. I talk to hundreds of traders every month. One of the common themes among new traders is not knowing what to trade. Thousands of stocks are moving in the market every single day, but finding a setup that is both consistent and a good fit is really hard. I use Trade Ideas software, www.trade-ideas.com, for scanning the market and finding good trades. I explained my scanners and watch list building in Chapter 4, and I will explain in detail later in this book what I am looking for with my scanner as well as my trading strategies. You will also see some pictures of my scanner in the sections that follow. If you join our free private chat room, you will see my scanner online in real time and will be able to observe how I use it. Community of traders. Trading alone is very difficult and can be emotionally overwhelming. It is beneficial to join a community of traders and ask them questions, talk to them if needed, learn new methods and strategies, get some hints and alerts about the stock market, and also make your own contributions. I personally trade in a private chat room with some of my friends and family. We can talk to each other and everyone can view my live screen and platform and watch how I am trading. It is a fun, interactive environment, and we all learn from each other. I frequently answer questions from other traders, and if there is anything I'm not sure of, I will ask other traders. There are some experienced traders in our chat room that I learn much from, and we tip each other off about potential good trades and setups. We would like to grow our chat room slightly, and therefore everyone who is reading this book is welcome to join with us. It is free, of course, and you will benefit from both watching me trade and hearing my responses to questions people have, including your own questions. If you join me, you will see that quite often I lose money. It is always a good feeling to see that losing money is not just limited to yourself, but that everyone, including experienced traders, have to take some losses. It is part of the process. There are many chat rooms that you can join on the internet. Some of them are free, but most of them require payment. You can join our chat room, of course for free, and see my screen in real time while I am trading and explaining my strategy. You can take trades with me, or just watch and listen. You can also take your own trades and still be part of my community. If you are interested in watching me or talking to me, check out our private chat room at www.vancouver-traders.com. It is extremely important to remember, however, that if you are in any community of traders, either our chat room or the dozens of others that are out there, you should not follow the pack. You need to be an independent thinker. Generally, people change when they join crowds. They become more unquestioning and impulsive, nervously searching for a leader whose trades they can mirror. They react with the crowd instead of using their minds. Chatroom members may catch a few trends together, but they get killed when trends reverse. Never forget that successful traders are independent thinkers. Simply use your judgment to decide when to trade and when to not. Chapter 6. Introduction to Candlesticks. To understand my strategies in the next section, we need to quickly review price action and the fundamentals of candlestick charts. The Japanese began using technical analysis and some early versions of candlesticks to trade rice in the 17th century. Much of the credit for candlestick development and charting goes to a legendary rice trader named Homa from the town of Sakata, Japan. While these early versions of technical analysis and candlestick charts were different from today's version, many of the guiding principles are very similar. Candlestick charting, as we know it today, first appeared sometime after 1850. It is likely that Homa's original ideas were modified and refined over many years of trading, eventually resulting in the system of candlestick charting that we now use. In order to create a candlestick chart, you must have a data set that contains 1. Open price. 2. Highest price in the chosen time frame. 3. Lowest price in that period. And 4. Closing price values for each time period you want to display. The time frame can be daily, 1 hour, 5 minute, 1 minute, or any other period you prefer. The hollow, white, or filled, red, portion of the candlestick is called the body. The long thin lines above and below the body represent the high/low range and are called shadows, also referred to as wicks and tails. The high is marked by the top of the upper shadow and the low by the bottom of the lower shadow. If the stock closes higher than its opening price, a hollow candlestick is drawn with the bottom of the body representing the opening price and the top of the body representing the closing price. If the stock closes lower than its opening price, a filled, usually red, candlestick is drawn with the top of the body representing the opening price and the bottom of the body representing the closing price. Compared to other forms of representing price action, many traders consider candlestick charts more visually appealing and easier to interpret. Each candlestick provides an easy-to-decipher picture of price action. A trader can immediately compare the relationship between the open and close as well as the high and low. The relationship between the open and close is considered vital information and forms the essence of candlesticks. Here is my 9th day trading rule. Rule 9. Hollow candlesticks, where the close is greater than the open, indicate buying pressure. Filled candlesticks, where the close is less than the open, indicate selling pressure. Traders can be divided into 3 groups: buyers, sellers, and the undecided. Buyers want to pay as little as possible, and sellers want to charge as much as possible. Their permanent conflict is reflected in bid-ask spreads. Ask is what a seller asks for merchandise. Bid is what a buyer offers for that merchandise. Prices are created by masses of traders, buyers, sellers, and undecided people. The patterns of prices and volume reflect the mass psychology of the markets. The goal of a successful day trader is to discover the balance of power between buyers and sellers and bet on the winning group. Fortunately, candlestick charts reflect this fight in action. A successful day trader is a social psychologist armed with a computer and charting software. Day trading is the study of mass psychology. The presence of undecided traders puts pressure on bulls and bears. Buyers and sellers move the prices fast because they know that they're surrounded by a crowd of undecided traders who could step in and snatch away their deal at any moment. Buyers know that if they think too long, another trader can step in and buy ahead of them. Sellers know that if they try to hold out for a higher price, another trader might step in and sell at a lower price. The crowd of undecided traders makes buyers and sellers more willing to deal with their opponents. Buyers are buying because they expect prices to rise. Sellers are selling because they expect prices to fall. Buying by bulls pushes markets up, or as I phrase it, buyers are in control. Selling by bears pushes the markets down, or as I express it, sellers are in control. Undecided traders make everything happen faster by creating a sense of urgency among buyers and sellers. Candlesticks tell us a great deal about the general trend of a stock and the power of buyers or sellers in the market. Candles are always born neutral. After birth, they can grow to become either bearish, bullish, or, on rare occasions, neither. When a candle is born, traders do not know what it will become. They may speculate, but they do not truly know what a candle is until it dies, closes. After a candle is born, the battle begins. The bulls and the bears fight it out, and the candle displays who is winning. If buyers are in control, you will see the candle move up and form a bullish candle. If sellers are in control of the price, you will see the candle move down and become a bearish candle. You may be thinking that this is all very obvious, but many traders don't see candles as a fight between buyers and sellers. That little candle is an excellent indicator that tells you who is currently winning the battle, the bulls, buyers, or the bears, sellers. Candles with large bodies toward the upside, like the figure below, are very bullish. As you can see, it means that the buyers are in control of the price action, and it is likely that they'll keep pushing the price higher. The candle not only tells you the price, it tells you that the bulls are winning and that they have power. Bullish candles. On the other hand, bearish candles are any candles that show a bearish body. So what does the bearish candle tell you? It tells you that the sellers are in control of the price action in the market. It tells you that the sellers are currently in control, so buying or a long position would not be a great idea. Red candles that have this big red body mean the open was at a high and the close was at a low. This is a good indicator of a bearishness in the market. Just by learning to read candlesticks, you will begin to generate an opinion on the general attitude for a stock. This is called price action. Understanding who is in control of the price is an extremely important skill in day trading. A major goal of a serious day trader is to discover the balance of power between bulls and bears and to bet on the winning group. If bulls are much stronger, you should buy and hold. If bears are much stronger, you should sell and sell short. If both camps are about equal in strength, wise traders stand aside. They let the bulls and the bears fight with each other and enter trades only when they are reasonably certain which side is likely to win. You never want to be on the wrong side of the trade. It is important, therefore, to learn how to read candlesticks and how to constantly interpret the price action while you are trading. There are hundreds of imaginatively named chart patterns that you will find with a Google search, including head and shoulders, cup and handle, abandoned baby, dark cloud cover, downside to Suki gap, dragonfly, morning star, evening star, falling three methods, harami, stick sandwich, 3 black crows and 3 white soldiers. Believe me, I did not make any of these names up. These candlesticks are really out there. As intriguing as their names might be, many of them, in my opinion, are useless and confusing. Therefore, I skip discussing most of them in this book. In my opinion, trend lines and most charting patterns are quite subjective and can result from wishful thinking and self-deception. You can draw a trend line across any prices or zones in a way that can change its slope and its message. If you're in a mood to buy, you can draw your trend line a little steeper. If you feel like shorting and squint at a chart, you'll recognize a head and shoulders pattern. None of those patterns are objective, and I am skeptical of claims regarding even classical formations, such as cup and handle and head and shoulders. The biggest pitfall with this kind of pattern charting is wishful thinking. Traders will find themselves identifying bullish or bearish patterns, depending on whether they're in a mood to buy or sell. In the next section, I'll give you a quick overview of the 2 most important patterns for day trading, spinning tops and dojis, and then, in Chapter 7, I will explain how you can trade using these patterns. Spinning tops. Spinning tops are candles that have similarly sized high wicks and low wicks that are usually larger than the body and will often be a little bit more indecisive. For the sake of poetry, let's call them candles of indecision. In these candlesticks, the powers of the buyers and the sellers are almost equal. Although no one is in control of the price, the fight continues on. Usually the volume is lower in these candlesticks as traders are waiting to see who wins the fight between the sellers and the buyers. Trends in price can change immediately after indecision candles, and they therefore are important to recognize in the price action. Dojis, simple, shooting star, and hammer. Dojis are another important candlestick pattern and come in different shapes and forms, but are all characterized by having either no body or a very small body. A doji is also an indecision candlestick that is similar to a spinning top. When you see a doji on your chart, it means there is a strong fight occurring between the bears and the bulls. Nobody has won the fight yet. At times dojis have unequal top and bottom wicks. If the top wick is longer, it means that the buyers tried unsuccessfully to push the price higher. These types of dojis, such as the shooting star, are still indecision candlesticks, but they may indicate that the buyers are losing power and that the sellers may take over. If the bottom wick is longer, as in hammer dojis, it means that the sellers were unsuccessful in trying to push the price lower. This may indicate an impending takeover price action by the bulls. All dojis indicate indecision and possible reversals if they form in a trend. If a doji forms in a bullish trend, it suggests that the bulls have become exhausted and the bears are fighting back to take control of the price. Similarly, if a doji forms in a bearish downward trend, it suggests that the bears have become exhausted and the bulls, buyers, are fighting back to take control of the price. Top reversal strategy with an indecision shooting star candlestick formed as sign of entry. After learning these candlesticks, it is important that you not get too excited too quickly. Candles are not perfect. If you take a trade every time you see a doji formed in a trend, you will end up with significant losses. Always remember that these candles only indicate indecision and not a definite reversal. To use indecision candles effectively, you must look for confirmation candles and ideally use them with other forms of analysis such as support or resistance levels, both of which are explained in Chapter 7. Note, the following chapter contains images and diagrams which you have to see to comprehend what will be explained, thus it is recommended to listen whilst looking at the book. Chapter 7. Most important day trading strategies. In this chapter, I will introduce some of my strategies, based on 3 elements. 1. Price action. 2. Technical indicators. And 3. Chart patterns. It is important to learn and practice all 3 elements at the same time. Although some strategies require only technical indicators, such as moving average and VWAP, it's helpful to also have an understanding of price action and chart patterns in order to become a successful day trader. This understanding, especially regarding price action, comes only with practice. As a day trader, you shouldn't care about companies and their earnings. Day traders are not concerned about what companies do or what they make. Your attention should only be on price action, technical indicators, and chart patterns. I know more stock symbols than the names of actual companies. I don't mingle fundamental analysis with technical analysis, I focus exclusively on the technical analysis. Now, having said that, as I mentioned in Chapter 4, I do hunt for a fundamental catalyst, a reason why a stock is running up. If I have a stock that's running up 80%, I want to know what the catalyst is, and I don't stop until I find out. So, it's a biopharmaceutical stock and they just got FDA approval, or they just passed through clinical trials. Okay, there's a catalyst, now I can understand what's going on. Beyond that, you won't find me listening in on conference calls or sifting through the earnings papers. I don't care about those aspects, because I'm not a long-term investor, I'm a day trader. We trade very quickly, guerrilla trading. At times we trade in time periods as short as 10 to 30 seconds. In case you're doubting me on this point, I can tell you from experience that in 10 seconds you can make thousands of dollars. I've done that. In 10 seconds, you can also lose thousands of dollars. I've done that too. When the market moves quickly, you need to ensure you're positioned in the right place to take advantage of the profits and reduce your risk exposure. There are millions of traders out there, and even millions more of strategies. Every trader needs their own strategy and edge. You need to find your spot in the market where you feel comfortable. I focus on these strategies because these are what work for me. I've come to recognize in my trading career that the best setups are the 7 strategies that I will be explaining in this chapter. These are simple strategies in theory, but they are difficult to master and require plenty of practice. These trading strategies give signals relatively infrequently and allow you to enter the markets during the quiet times, just like the professionals do. Another point to remember is that in the market right now, over 60% of the volume is algorithmic high-frequency trading. That means you are trading against computers. If you've ever played chess against a computer, you know that you're eventually going to lose. You might get lucky once or twice, but play sufficient times and you are guaranteed to be the loser. The same rule applies to algorithmic trading. You're trading stocks against computer systems. On the one hand, that represents a problem. It means that the majority of changes in stocks that you are seeing are simply the result of computers moving shares around. On the other hand, it also means that there's a small handful of stocks each day that are going to be trading on such heavy retail volume, as opposed to institutional algorithmic trading, that you will overpower the algorithmic trading and you and I, the retail traders, will control that stock. Each day, you need to focus on trading those particular stocks. These are what I call in chapter for the alpha predators, stocks that are typically gapping up or down on earnings. You must look for the stocks that have significant retail traders' interest and significant retail volume. These will be the stocks you will buy, and together, we the people, the retail traders, will overpower the computers, just like in a storyline for the next Terminator sequel. I personally use the candlestick charts explained in Chapter 6. Each candlestick represents a period of time. As I mentioned before, you can choose daily charts, hourly charts, 5-minute charts, even 1-minute charts. My preference is 5-minute charts, because I believe a 1-minute chart is too noisy, and at times you can be misled by normal price movement in a 1-minute interval. And please, remember, my philosophy of trading is that you must master only a few solid setups to be consistently profitable. In fact, having a simple trading method consisting of a few minimal setups will work to reduce confusion and stress and allow you to concentrate more on the psychological aspect of trading, which is what separates the winners from the losers. Trade management. Before explaining my strategies, it is important to know about my order entry, exit, and trade management. It always intrigues me in the www.vancouver-traders.com chat room when two elite traders select the same stock, one long and the other short. Often, by the end of the day, both are profitable, proving that experience and trade management are more important than the stock and the direction that traders pick. My trade size depends on the price of the stock and on my account and risk management rule, Chapter 3, but 800 shares is my usual size. 1. I buy 800 shares all at once. 2. I sell 400 shares in the first target, bringing my stop loss to break-even entry point. 3. I sell another 200 shares in the next target point. 4. I usually keep the last 200 shares until I am stopped out. I always retain some shares in case the prices keep moving in my favor. Some professional traders never enter the trade all at once. They scale into the trade, meaning they buy at various points. They might start with 100 shares and then add to their position in various steps. For example, for a 1,000 share trade, they enter either 500/500 or 100/200/700 shares. If done correctly, this is an excellent method of risk and trade management. However, managing the position in this system is extremely difficult. Many new traders who are trying to do this will end up overtrading and will lose their money in commissions, slippage, and averaging down the losing trades. I rarely scale into a trade, but at times I will, especially in very highly volume traded stocks. But remember, scaling into a trade is a double-edged sword, and beginners may use it incorrectly as a way to average down their losing positions, sending good money after bad. I don't recommend this method for beginners. Although they can appear similar, there is a huge difference between scaling into a trade and averaging down a losing position. For beginners, averaging down a losing trade is a recipe for wiping out your account, especially with small accounts that cannot stand several rounds of averaging down. ABCD pattern. The ABCD pattern is the most basic and the easiest pattern to trade, and it is an excellent choice for beginner and intermediate traders. Although it is simple and has been known for a long time, it still works very effectively because many traders are still trading it. As mentioned earlier, it has a self-fulfilling prophecy effect. You should do whatever all of the other traders are doing because a trend is your friend. A trend may very well be your only friend. Let's take a look at this pattern. ABCD patterns start with a strong upward move. Buyers are aggressively buying a stock from point A and making constantly new highs of the day, point B. You want to enter the trade, but you should not chase the trade, because at point B, it is very extended and already at a high price. In addition, you cannot say where your stop should be. You must never enter a trade without knowing your stop. At point B, traders who bought the stock earlier start slowly selling it for profit and the prices come down. Still, you should not enter the trade because you don't know where the bottom of this pullback will be. However, if you see that the price does not come down from a certain level, such as point C, it means that the stock has found a potential support. Therefore, you can plan your trade and set up stops and a profit-taking point. Let's take a look at Ocean Power Technologies Incorporated, ticker OPTT, at July 22, 2016, when they announced that they had a new $50 million contract to build a new ship. There's a fundamental catalyst. Remember Chapter 2? The stock surged up from $7.70 A to $9.40 B at around 9:40 a.m. I, along with many other traders who had not heard the news, waited for point B and then a confirmation that the stock wasn't going to go lower than a certain price, point C. When I saw that point C was holding as a support and buyers wouldn't let the stock price go any lower than $8.10 C, I bought 1,000 shares of OPTT near C, and my stop was below point C. I knew that when the price went higher, closer to B, buyers would jump on massively. As I mentioned before, the ABCD pattern is a very classic strategy, and many retail traders look for it. I purchased stock between points B and C, close to point D. The volume suddenly spiked, which meant that traders had jumped into the trade. My exit would be when the stock made a new low, which was a sign of weakness. As you see, OPTT had a nice run up to around $12. Let's look at another example, this time for SPU, on August 29, 2016. There are actually two ABCD patterns. I marked the second one as ABCD pattern. Usually as the trading day progresses, volumes become lower and therefore the second pattern is smaller in size. Please note that you will always have high volumes in points B and D, and of course points B and D in this example. To summarize my trading strategy for the ABCD pattern. 1. When I observe with my scanner or I'm advised by someone in our chat room that a stock is surging up from point A and reaching a big new high for the day, point B, I wait to see if the price makes a support higher than point A. I call this point C. I do not jump into the trade right away. 2. I watch the stock during its consolidation period. I choose my share size and stop and exit strategy. 3. When I see that the price is holding support at level C, I enter the trade close to the price of point C in anticipation of moving forward to point D or higher. 4. My stop is the loss of point C. If the price goes lower than point C, I sell and accept the loss. Therefore, it is important to buy the stock close to point C to minimize the loss. Some traders wait and buy only at point D to make sure that the ABCD pattern is really working. In my opinion, that is reducing your reward and increasing your risk. 5. If the price moves higher, I sell half of my position at point D and bring my stop higher to my entry point, break even. 6. I sell the remaining position as soon as my target hits or I feel that the price is losing steam or that the sellers are acquiring control of the price action. Bull flag momentum. In day trading, bull flag is a momentum-fast execution strategy that usually works great on low-float stocks, Chapter 4. I believe bull flag is a scalping strategy because these flags won't last long and you must scalp the trade, get in quickly, take your profit, and then get out. This pattern is named bull flag because it resembles a flag on a pole. In bull flag, you have several large candles going up, like a pole, and you also have a series of small candles moving sideways, like a flag, or, as we day traders say, consolidating. Consolidation means that the traders who bought stocks at a lower price are now selling and taking their profits. Although that is happening, the price does not decrease sharply because buyers are still entering into trades and the sellers are not yet in control of the price. Many traders will miss purchasing the stock before the bull flag starts. It is risky to buy stock when the price is increasing. That's called chasing the stock. Professional traders aim to enter the trade during quiet times and take their profits during wild times. That, of course, is the total opposite of how amateurs trade. They jump in or out when stocks begin to run, but grow bored and lose interest when the prices are, shall I say, sleepy. Chasing the stocks is an account killer for beginners. You must wait until the stock finds its high point, and then wait for the consolidation. As soon as the price breaks up in the consolidation area, you can begin purchasing stocks. Usually a bull flag will show several consolidation periods. I enter in only the first and second consolidation periods. Third and higher consolidation periods are risky because the price has probably been very extended in a way that indicates that the buyers will soon be losing their control. Let's study an example of a bull flag of RIGL on August 30, 2016. As you can see, my scanner showed RIGL at 12:36 and 15 seconds p.m. As soon as I saw that, I realized that there was also a very high relative volume of trading, which made this a perfect setup for day trading. I waited for the first consolidation period to finish and, as soon as the stock started to move towards its high for the day, I jumped into the trade. My stop loss would be the breakdown of the consolidation period. I marked my exit and entry in the picture below. As you can see, if you had wanted to wait for a second consolidation period in hope of the third bull flag, you would probably have been stopped out. That is why I usually enter the first and second bull flags, but not the third one. Entry, stop and exit of a bull flag strategy on RIGL. To summarize my trading strategy. 1. When I see a stock surging up, either on my scanner or when advised by someone in our chat room, I patiently wait until the consolidation period. I do not jump into the trade right away. You will recall that is the dangerous act of chasing. 2. I watch the stock during the consolidation period. I choose my share size and stop and exit strategy. 3. As soon as prices are moving over the high of the consolidation candlesticks, I enter the trade. My stop loss is the break below the consolidation periods. 4. I sell half of my position and take a profit on the way up. I bring my stop loss from the low of the consolidation to my entry price, break even. 5. I sell my remaining positions as soon as my target hits or I feel that the price is losing steam and the sellers are gaining control of the price action. As I mentioned, many people, including myself, buy only at or near the breakout, similar to the ABCD pattern. The bull flag is essentially an ABCD pattern that will happen more on low float stocks. It's fast and it will fade away more quickly. Therefore, it is more or less a momentum scalping strategy. Scalpers buy when a stock is running. They rarely like to buy during consolidation, during that waiting and holding phase. These types of stocks usually drop quickly and brutally, so it is important for you to jump only when there is a confirmation of breakout. Waiting for the stocks to break the top of a consolidation area is a way of reducing your risk and exposure time. Instead of buying and holding and waiting, which increases exposure time, scalpers just wait for the breakout and then send their order. Get in, scalp, and get out quickly. That's the philosophy of momentum scalpers. Get in at the breakout. Take your profit. Get out of the way. The bull flag pattern is found within an uptrend in a stock. The bull flag is a long-based strategy. You should not short a bull flag. I personally don't trade much momentum. It is a risky strategy, and beginners should be very careful trading these. If you choose to, trade only small size and only after sufficient practice in simulators. You will also need a super fast execution system for scalping. Top and bottom reversal trading. Top and bottom reversals are among the easiest trading strategies. Day traders love using them because they have a very defined entry and exit point and a very high profit to loss ratio. In this section, I'm going to explain how to find reversal setups using scanners, how to read the Bollinger Bands to find extremes, how to use indecision or doji candlesticks to take an entry, how to understand where to set your stops and your profit targets, and how to trail your winners. If you are part of our private chat room, you will hear me say time and time again that what goes up must come down. Don't chase the trade if it is too extended. The inverse is also true. What goes down will definitely come back up to some extent. When a stock starts to sell off significantly, there are two reasons behind it. 1. Institutional traders and hedge funds have started selling their large position to the public market and the stock price is tanking. 2. Retail traders have started short selling the stock, but they will have to cover their shorts sooner or later. That is where you wait for an entry. When short sellers are trying to cover their shorts, the stock will reverse. I'm going to illustrate this strategy with a few examples so that you can see exactly what to look for. Below is an example of what it looks like to find a stock that sold off really hard right after the market opens. Moves like this are extremely hard to catch for the short side, because when you find the stock, it is already too late to enter the short selling trade. But please, remember the mantra, what goes up, must come down. Therefore, you have the option of waiting for a reversal opportunity. Each reversal strategy has 4 important elements. 1. At least 5 candlesticks, 5 minutes, moving upward or downward. 2. The stock is trading close to or outside of the Bollinger Bands. Bollinger Bands are an indicator of volatility, and stocks usually stay inside of these bands. 3. The stock will have an extreme RSI indicator, relative strength index. An RSI above 90 or below 10 will pique my interest. If you are not familiar with what an RSI indicator is, you can do a Google search or ask me in our chat room. Your trading platform will probably have an RSI indicator built into it. These 3 elements demonstrate that a stock is really stretched out, and you must pay close attention to the scan for all of these data points. You must simultaneously look for a certain RSI level, a certain number of consecutive candles, and a certain position within the Bollinger Bands. 4. When the trend is going to end, usually indecision candles, such as a spinning top or doji, form. That is when we need to be ready. In reversal trading, you are looking for one of these indecision candlesticks, spinning tops or dojis. They are an indication that the trend may soon change. A doji is a candle that has a wick longer than its body. You can see a picture of a bearish doji below. It has that long upper wick that some would call a top and tail and that others would call a shooting star. This candle tells us 4 things: the open price, the close price, the high of that period, and the low of that period. So, when you have a candle with a top tail, you know that at some point during that candle period the price moved up, was unable to hold at that level, and was then sold off. It depicts a bit of a battle taking place between the buyers and the sellers in which the buyers lost their push-up. It is a good indication that the sellers may soon control the price and will push that price down. The same is true about a bullish doji. You can also see a picture of a bullish doji below. It has that long lower wick that some would call a bottom tail and others would call a hammer. When you have a hammer candle with a bottom tail, you know that at some point during that candle period the price moved down, was unable to hold at those low levels, and was bought up. This indicates a battle between the buyers and the sellers in which the sellers lost their push down. It is a good indication that the buyers may now gain control of the price and push that price up. In reversal trading, you look for either doji or indecision candlesticks. They are an indication that the trend may soon change. In reversal strategies, you are looking for a clear confirmation that the pattern is beginning to reverse. What you definitely don't want is to be on the wrong side of a reversal trade, or, as we call it, catching a falling knife. It doesn't sound like a good idea in real life, and it's not a good idea in trading. It means that when a stock is selling off badly, the falling knife, you don't want to buy on the assumption that it should bounce. If the stocks are dropping, you want to wait for the confirmation of a reversal. This will usually be 1. The formation of a doji or indecision candle, and 2. The first 1-minute or the first 5-minute candle to reach a new high. That is my entry point. I set my stop at the lows. In reversal trading, the RSI should be at the extremes, above 90, below 10, and that final candle should be outside the Bollinger Bands. Once you have your entry requirements listed, you must then look for an actual entry. An entry for me is going to be either the first 1-minute or the first 5-minute candle to reach a new high. When you've had a long run of consecutive candles making new lows, the first candle that makes the new high is very significant. That's my entry point. There are times when I'll use the 1-minute chart, but typically I'll wait for the 5-minute chart because it is a much better confirmation. The 5-minute chart is cleaner. The first 5-minute candle to make a new high is the point at which I get in the reversal, with a stop either at the low of the day or simply down around 20 to 30 cents. Usually, if a stock goes 30 cents against me, I will admit defeat, recognize that I mistimed my entry, and try again rather than continue to hold. At times, especially on stocks that are more expensive or more volatile, I'll simply use a 20 or 30 cent arbitrary stop if the low of the day is too far away. Once you're in one of these trades, your exit indicators are quite simple. If the stock pops up and then suddenly moves back down on a bottom bounce, you stop out for a loss. If you jump in the stock and it ends up just going sideways, it's a sign that you are probably going to see a flag, a reverse flag, and that is an indication that the price is probably going to continue to drop. If I get in and I hold for a few minutes and the price stays flat, I get out, no matter what happens after that. I may be wrong, but so be it. I don't like to expose my account to the unknown. I need to be in the right setup, and if it is not ready yet, I'm out. If I get into the profit zone, I can start adjusting my stop, first to break even, and then to the low of the last 5-minute candle. I will then keep adjusting my stop as I move up. You must realize that almost all of the big moves will eventually be corrected. What goes up must come down. In reversal strategies, one of the main advantages is the opportunity to watch stocks that are running up, while simultaneously calculating possible resistance points and areas that could provide a good reversal opportunity. This allows you to resist being impulsive and rushing into the trade. You can instead take your time to watch the trade develop and wait for the momentum to begin to shift. An important metaphor many traders use when talking about reversal strategies is that of a rubber band. When stocks become really stretched out to the downside, then inevitably they're due for a correction. So, when a stock is really squeezing down, you will know that at some point it's going to make a bounce, and you want to be in there for the bounce. What you definitely don't want to be is to be the one still selling. As I said before, that's like catching a falling knife. If stocks are dropping, you want to wait for the confirmation of the reversal. This will probably be the first 1-minute or the first 5-minute candle to make a new high. That's my cue to jump in. I set my stop at the lows. Bottom reversal. This beautiful illustration on Emergent Biosolutions Incorporated (EBS) shows a perfect reversal that I found using my stock scanners. An indecision candlestick at the bottom of the downtrend signifies a potential reversal, and as you see right after that you see a big swing back up. I took this trade right after seeing indecision doji, and kept my stop at the low of that indecision candlestick. The biggest advantage of reversal strategies is that they overcome the difficulty of anticipating when stocks will make major moves. You will probably miss the moment when the stock starts to sell off, and you won't have the time to short the stock for profit, but you can always prepare for the reversal trade. I found Alira Incorporated on June 27, 2016 at 10:57 a.m. using a software program that scans the stock market and lets me know exactly what I want to know. My scanner, at 10:57 a.m., showed me that ALR had 7 consecutive candles to the downside, a relatively low float, 80 million shares, and a relative volume of 1.21, which meant it was trading higher than usual. I actually did not take this trade because I missed my entry, but I wanted to show you what overall trading strategies look like for bottom reversals. When you're looking at reversals, you want to make sure that you only trade extremes. The example we just saw was a stock that made an extreme move to the downside before that move reversed. A stock that's been selling off slowly all day long usually isn't suitable for a reversal. Instead, it's helpful to think of stocks the way you think of rubber bands. You want to see them really stretched out to the downside or, for short selling, really stretched out to the upside. You want to see the big extension, which means that you want to see considerable volume. Once you do, you then look for a couple of key indicators that will suggest that the tide may be about to turn, and that's when you take the position. I've said it many times, what goes up must come down. Oftentimes these stocks will give up days and weeks or years worth of price gain in just a matter of minutes. It is very critical to be able to time the reversal. I'll say it again, the key to the success with top and bottom reversals is trading the extremes. How do I quantify these extremes? There are a few things I look for. 1. An extreme RSI above 90 or below 10 will pique my interest. 2. A candle outside of the Bollinger Bands is also going to interest me. 3. Finally, seeing 5 to 10 consecutive candles ending with an indecision candle or a doji is definitely going to catch my interest. These candles usually show that sellers are losing their control while buyers are becoming more powerful, and that indicates the end of a trend. I will add a caveat to that final point. There will be times when you will have 5 to 10 consecutive candles without much price action. They may be drifting down slowly, but not quickly enough for you to sense that it's a good reversal. You must look for a combination of these indicators all occurring at the same time. Never sell short just because the prices are too high. You should never argue with the crowd's decision, even if it doesn't make sense to you. You do not have to run with the crowd, but you should not run against it. Utilizing all of these different factors will create the strategy that has been extremely successful for me due to its incredible profit-to-loss ratio. Your profit-to-loss ratio is your average winners versus your average losers. Many new traders end up trading with a very poor profit-to-loss ratio because they sell their winners too soon and they hold their losers too long. This is an extremely common habit among new traders. The reversal strategy, however, lends itself to having a larger profit-to-loss ratio. To return to the rubber band analogy, by following such a strategy, you will always buy stocks when the rubber band is stretched as far as it can go. When you time this right, you're in as the rubber band snaps back, and you can then ride the momentum right back up. To summarize my trading strategy for the bottom reversal strategy. 1. I set up a scanner that shows me stocks with 4 or more consecutive candlesticks going downward. When I see a stock hit my scanner, I quickly review the volume and level of resistance or support near the stock to see if it is a good trade or not. 2. I wait for confirmation of a reversal strategy. 1. Formation of a bearish doji or indecision candle. 2. Candlesticks being very close or outside of the Bollinger Bands. And 3. The RSI must be lower than 10. 3. When I see the stock make a new 5-minute high, I buy the stock. 4. My stop loss is the low of the previous red candlestick or the low of the day. 5. My profit target is 1. The next level of support or 2. VWAP, volume weighted average price, described later in this chapter, or moving averages, or 3. The stock makes a new 5-minute high, which means that the buyers are once again gaining control. Top reversal. A top reversal is similar to a bottom reversal, but on a short selling side. Let's take a look at Bed Bath & Beyond Incorporated as it traded on June 23, 2016. My scanner showed BBBY going up at 10:18 a.m. with 6 consecutive candles. It had a relative volume of 21.50, which meant it was trading significantly higher than usual. That was because, as discussed, retail traders look for unusual trading volume. I took this trade and made a good profit on it. The candlesticks were not outside of the Bollinger Bands, but because it was trading with very unusual volume and forming a nice doji on top, I decided to take the trade. I shorted stock when a new 5-minute candlestick was made, with my stop being the break of the high of the last 5-minute candles. I covered my shorts at $43.40 for a 60-cent profit when the stock made a new 5-minute high. To summarize my trading strategy for the top reversal strategy. 1. I set up a scanner that shows me stocks with 4 or more consecutive candlesticks moving upward. When I see the stock hit my scanner, I quickly review the volume and level of resistance or support near the stock to see if it is a good trade or not. 2. I wait for confirmation of a reversal strategy. 1. Formation of a bearish doji or indecision candle. 2. Candlesticks being very close or outside of Bollinger Bands. And 3. The RSI must be higher than 90. 3. When I see the stock make a new 5-minute low, I start short selling the stock. 4. My stop will be the high of the previous candlestick or simply the high of the day. 5. My profit target is 1. The next level of support, or 2. VWAP or moving averages, or 3. When the stock makes a new 5-minute high, which means the buyers are once again gaining control. Some day traders focus exclusively on reversal trades and actually base their entire careers on them. Reversal trades are certainly the most classic of the various strategies with a very high risk-reward ratio and, interestingly, you will always find stocks that are good candidates for reversal trades. I myself am trading more and more reversal trades these days, especially during late morning and afternoon trading. However, reversal trading is not yet the cornerstone of my trading strategies. I am more of a VWAP trader and support or resistance trader, which I will explain later. Moving average trend trading. Some traders use moving averages as potential entry and exit points for day trading. Many stocks will start an upside or downside trend respecting their moving averages in 1-minute and 5-minute charts as type of a moving support or resistance line. Traders can benefit from this behavior and ride the trend along moving average, on top of moving average for going long or below moving average for short selling. I have been asked why moving averages are becoming support or resistance, and the answer is because many traders are looking at these lines and making decisions based on them. Therefore, they have a self-fulfilling prophecy effect. There is no fundamental reason behind moving averages being a support or resistance line. I use 9 and 20 exponential moving averages, EMA, and 50 and 200 simple moving averages, SMA. I won't go into the details of what moving averages are and the differences between simple and exponential in order to keep this book short. You can, however, do a Google search and find information about these moving averages, or you can of course contact me directly through www.vancouver-traders.com with any questions you may have. Your charting software will have most of the moving averages built in. They are ready to be used and there is no need to change the default setting in them. As you can see, at 15:06 p.m. I noticed NUGT has formed a bull flag. I saw that a consolidation period was happening on top of 9 EMA. As soon as I saw that 9 EMA was holding as the support, I jumped on the trade and rode the trend until the price broke the moving average at 15:21 p.m. I've marked my entry and exit points on the chart. Let's take a look at another example, Celgene Corporation, CLG, on June 16, 2016. In the chart below, you will see how you can trade based on 20 EMA in a 1-minute chart. I marked my entry and exit points on the chart. Another example is EXAS on July 28, 2016 with 9 EMA. To summarize my trading strategy for moving average trend trading. 1. When I am monitoring a stock and notice a trend is respecting moving average, I consider trend trading. I quickly look at the previous day's trading data to see if the stock is responding to these moving averages in a 1-minute or 5-minute chart. I have 9 and 20 EMA and 50 and 200 SMA. 2. Once I learn which moving average is more suitable to the behavior of the trade, I buy the stock after confirmation of moving averages as a support, and I buy as close as possible to the moving average line, in order to have a small stop. My stop will usually be 5 cents below the break of moving average line. 3. I ride the trend until the break of moving average. 4. I never use trailing stops and I constantly monitor the trend with my eyes. 5. If the stock is moving really high away from the moving average, I take some profit, usually at half position. I do not always wait until the break of moving average for my exit. I personally don't trade very often based on moving averages. I look at them to see potential levels of support or resistance, but I rarely make any trend trade based upon their trend because, in a trend trade strategy, you are usually exposed in the market for a considerable time. Some trend trades can last as long as several hours, and that is too long for my personality. Another major problem I have with moving average trending is that you don't know in the stock you want to trade which moving average is accurately acting at a support or resistance level. In the examples above, if I changed my moving average from 9 to 12, or to 15, or to any other number, then it won't act as a nice clean support. I use 9 and 20 EMA on my default charts, but I know not everyone does. Some traders are using 11 and 21 EMA. That in the end is a significant problem with moving average trading. You don't know which moving average is best for a stock, and you obviously do not have enough time to test them all out during the trading day. I recommend using either 9, 20 EMA and 50 in 200 SMA or 11, 21 EMA and 50 and 200 SMA. Having said that, moving average trend strategy is an excellent strategy for beginners, because it usually does not require a very fast decision-making process and trade execution. In addition, stop loss and entry points can be clearly recognized from the moving average on the charts. As I discussed, strategies depend on your account size, personality, psychology of trading and risk tolerance, as well as on your software and the tools and brokers that you have. The combination of all of these factors have led me to be a VWAP trader and support or resistance trader, something I will explain in the next section. However, I want to emphasize that trade strategies are not something that you can imitate just from reading a book, speaking with a mentor, or attending a class. You have to slowly and methodically develop your preferred method and then stick with it. There is nothing wrong with any strategy if it works for you. There is no good and bad in any of these strategies. It truly is a matter of personal choice. Now let me explain what my favorite trading strategies are. VWAP trading. Volume weighted average price, or VWAP, is the most important technical indicator in day trading. Definitions of VWAP can be found in both Wikipedia and many other online resources. I will skip explaining it in detail for the sake of keeping this guide short, but essentially, VWAP is a moving average that takes into account the volumes of the stock being traded. Other moving averages are calculated based only on the price of the stock in the chart, but VWAP also considers the number of the shares that the stock is traded on every price. Your trading platform probably has VWAP built into it, and you can use it without changing its default setting. VWAP is a good indicator of who is in control of the price action, buyers or sellers. When stock is traded above VWAP, it means that the buyers are in overall control of the price. When a stock price breaks below the VWAP, it is safe to assume that the sellers are gaining control over the price action. Trading based on VWAP can be very easy for beginner traders because so many traders are studying the VWAP and making decisions based on it. Therefore, a beginner trader can easily be on the right side of the trade. When a stock tries to break the VWAP but cannot, you can short stock because you can safely assume that other traders that are watching will also begin to short. A trading strategy based on VWAP is a simple and easy strategy to follow. I usually short stocks when traders try but fail to break the VWAP in 5-minute charts. At around 10:30 a.m. on June 24, 2016, I noticed that SCTY had found a support over VWAP. I purchased 1,000 shares of the stock with the anticipation of moving toward $22 with VWAP as a support. My stop was a close below VWAP. I first sold a half-size position at $22.50 and then moved my stop to break even. I sold another position at $22 because I know half dollars, such as $1.50, $2.50, $3.50, and whole dollars, $1, $2, $3, usually act at a support or resistance level. VWAP also works well when you want to short stocks. Let's take a look at another recent trade that I took on Solar City Corporation, this time on June 22, 2016, and this time on the short side. At around 11 a.m., I noticed that SCTY had faced a resistance over VWAP. I shorted the stock with the anticipation of losing the VWAP at around $23. Around 12 p.m. buyers gave up and the sellers took control of the price action. I had a nice run down to $22 and covered my shorts at $22 for a good $1,000 profit. To summarize my trading strategy for VWAP trading. 1. When I make my watch list for the day, I monitor the price action around VWAP. If a stock shows respect toward VWAP, then I wait until a confirmation of the VWAP break or support. 2. I usually buy as close as possible to minimize my risk. My stop will be a break and close 5-minute chart below VWAP. 3. I keep the trade until I hit my profit target or until I reach a new support or resistance level. 4. I usually sell half positions near the profit target or support or resistance level and move my stop up to my entry point or break even. A similar approach will work equally as well when you short a stock. Support or resistance trading. Horizontal support or resistance trading is my favorite style of trading. The market doesn't know diagonals. It remembers price levels, which is why horizontal support or resistance lines make sense, but diagonal trend lines are subjective and open to self-deception. I therefore avoid trend lines because, in my opinion, they are wildly subjective and result in wishful thinking and self-deception. In fact, trend lines are among the most deceptive of all tools. You can draw a trend line across the prices or zones in a way that can change its slope and its message. If you're in a mood to buy, for example, you can draw your trend line somehow steeper. After making thousands of trades and looking at thousands of charts, I've come to the conclusion that the market doesn't know diagonals. It remembers price levels, which is why horizontal support or resistance lines make sense, but diagonal trend lines are subjective and open to self-deception. Support is a price level where buying is strong enough to interrupt or reverse a downtrend. When a downtrend hits support, it bounces like a diver who hits the bottom of the ocean and then automatically pushes away from it. Support is represented on a chart by a horizontal line connecting two or more bottoms, see the figure below. Resistance is a price level where selling is strong enough to interrupt or reverse an uptrend. When an uptrend hits resistance, it acts like a person who hits their head on a branch. While climbing a tree, they stop and might even tumble down. Resistance is represented on a chart by a horizontal line connecting two or more tops. Minor support or resistance causes trends to pause, while major support or resistance causes them to reverse. Traders buy at support and sell at resistance, making their effectiveness a self-fulfilling prophecy. Using this method, every morning I shortlist the stocks that I would like to trade based on the criteria I set forth in Chapter 4, a stock that has fundamental catalysts such as news, an extreme earnings report, or a new drug approval. These stocks are the ones that retail traders are watching and planning to trade. Before the market opens, I go back to the daily charts and find price levels that have been shown in the past to be critical. Finding price support or resistance levels is tricky and requires trading experience. If you watch me trading every morning, you will see how I place my support or resistance lines on my alpha predators. Support or resistance lines in daily charts are not always easy to find, and at times you will not be able to draw anything clear. If I cannot see anything clear, I don't have to draw anything. There is a good chance that other traders will also not see these lines clearly, and therefore there is no point in forcing myself to draw support or resistance lines. In that case, I will plan my trades based on the VWAP or moving averages or chart patterns that I earlier discussed. Here are some hints for drawing support or resistance lines. 1. You will usually see indecision candles, Chapter 6, in the area of support or resistance because that is where buyers and sellers are closely fighting each other. 2. Half dollars and whole dollars usually act at a support or resistance level. If you don't find a support or resistance line around these numbers on daily charts, remember that in intraday these numbers can act as an invisible support or resistance line. 3. You should always look at the recent data to draw lines. 4. The more of a line that is touching price lines, the more that the line is a better support or resistance and has more value. Give that line more emphasis. 5. Only the support or resistance lines in the current price range are important. If the price of the stock is currently $20, there is no point in finding support or resistance lines in the region when it was $40. It is unlikely that the stock will move and reach that area. Find only the support or resistance area that is close to your day trading range. 6. Support or resistance lines are actually an area and not exact numbers. For example, when you find an area around $19.69 as a support line, you must expect price action movement around that number but not at exactly $19.69. Depending on the price of the stock, an area of 5 to 10 cents is safe to assume. In the example with a support line of $19.69, the real support area might be anything from $19.62 to $19.72. 7. The price must have a clear bounce from that level. If you are not certain if the price has bounced in that level, then it is probably not a support or resistance level. 8. For day trading, it is better to draw support or resistance lines across the extreme prices rather than across areas where the bulk of the bars stopped. This is the complete opposite of swing trading. For swing trading, you need to draw support or resistance lines across the edges of congestion areas where the bulk of the bars stopped rather than across the extreme prices. Placing support or resistance lines, although tricky, is actually quite simple once you get the hang of it. Let's review a recent trade that I took based on these lines. CarMax, ticker KMX, the United States' largest used car retailer, on June 21, 2016 had extreme earnings and its stock gapped down over 3%. That was a perfect opportunity for retail traders like me to find a good trade plan. I quickly found the support or resistance area level on a daily chart and watched the price action around those levels. After reviewing the daily charts, I found two levels of $48.09 and $48.48. When the market opened, I watched the stock and realized that the area of around 48.09 acted as a support. When I saw an indecision candle around the support line, I purchased 1,000 shares of KMX with a stop of below $48. The stock surged up toward the next level at $48.48 and, interestingly enough, $48.48 was also close to my invisible half-round number, $48.50. I sold half of my position for a profit and kept the balance for going higher. Since I did not have any other support or resistance area higher up, I decided to sell my remaining position at the invisible resistance line of $49. As you can see, $49 acted as a strong resistance line, and the stock sold off from that level. To summarize my trading strategy for support or resistance trading. 1. Each morning, when I make my watch list for the day, I quickly look at the daily charts for my watch list and find the area of support or resistance. 2. I monitor the price action around those areas on a 5-minute chart. If an indecision candle forms around that area, that is the confirmation of the level and I enter the trade. I usually buy as close as possible to minimize my risk. Stop would be a break and a close 5-minute chart under support or resistance level. 3. I will take profit near the next support or resistance level. 4. I keep the trade open until I hit my profit target or I reach a new support or resistance level. 5. I usually sell half positions near the profit target or support or resistance level and move my stop up to my entry point for break-even. 6. If there are no next obvious support or resistance levels, I will consider closing my trade at or near $half or round dollar levels. A similar approach will also work when you short a stock. Other trading strategies. You have now read briefly about my trading strategy. You may be wondering what other traders do. As I mentioned before, there are unlimited numbers of trading strategies that individuals have developed for themselves. Traders often choose their strategies based on such factors as account size, amount of time that can be dedicated to trading, trading experience, personality, and risk tolerance. You should develop your own strategy. A trading strategy is very personalized to each individual. My risk tolerance and psychology are most likely different from yours and from those of other traders. I might not be comfortable with a $500 loss, but someone who has a large account can easily hold on to the loss and eventually make profit out of a losing trade. You cannot mirror trade anyone else, you must develop your own risk management method and strategy. Some traders focus heavily on technical indicators like the RSI, the Moving Average Convergence Divergence, also known as the MACD, or the Moving Average Crossover. There are hundreds, if not thousands, of sophisticated technical indicators out there. Some traders believe they have found the holy grail of technical indicators, and it might be a combination of RSI or the Moving Average Crossover. I don't believe in any of them. I don't think that they work for day trading, especially over the long term. Some of my day trader colleagues may disagree with me, but my personal experience is that you cannot enter a trade with a systemic approach and then let indicators dictate your entry and exit. That is my next rule. Rule 10: indicators only indicate, they should not be allowed to dictate. Computers are trading all of the time. When you set up a system for trading that has no input or requires no decisions by the trader, then you are entering the world of algorithmic trading, and you will lose trades to investment banks that have million-dollar algorithms and billions of dollars in cash for trading. Of course, I use the RSI in my scanner for some of my trading strategies, and in particular for reversal trading. Obviously, I have scanners that rely on a high or low RSI, but those are more conditioned to find stocks at extremes. This is not by any means a buy or sell indicator. Develop your own strategy. You must still find your own place in the market. I may be a 1-minute or a 5-minute trader, you may be a 60-minute trader. Some may be daily or weekly traders, swing traders. There's a place in the market for everyone. Consider what you are learning in this book as pieces of a puzzle that together make up the bigger picture of trading. You're going to acquire some pieces here, you're going to pick up pieces on your own from your own reading and research, and, overall, you will create a puzzle that will develop into your own unique trading strategy. I don't expect everything I do to work exactly the same for you. I'm happy to help you develop a strategy that is going to work for you, your personality, your account size, and your risk tolerance. The key for now is that you master one strategy. Once you can tread water in the market with your one strategy, you can be a trader without blowing up your account. This is simply a matter of spending time in the chair. The more time you spend watching your charts, the more you will learn. This is a job where you survive until you can make it. You can start casting out later, but first you need to master just one strategy. It can be the VWAP trade, it can be a bull flag momentum strategy, it can be a reversal strategy, or you can create a strategy of your own. Narrow the choices down, develop that area of strength into a workable strategy, and then use that strategy to survive until you are able to develop others. It is absolutely critical for every trader to be trading a strategy. Plan a trade, and trade the plan. I wish someone had said to me when I first started training, Andrew, you need to trade a strategy. If you're trading with real money, you must be trading a written strategy, and it must have historical data to verify that it's worth trading with real money. You cannot change your plan when you have already entered the trade and have an open position. The truth about traders is that they fail. They lose money, and a large percentage of those traders are not getting the education that you are receiving from this book. They're going to be using live trading strategies that are not even hammered out. They will just be haphazardly trading a little of this and a little of that until their account is gone, and then they will wonder what happened. You don't want to live trade a new strategy until you've proven that it's worth investing in. You may practice 3 months on a simulator, and then trade small size with real money for 1 month, and then go back to the simulator to work on your mistakes or practice new strategies for another 3 months. There is no shame in going back to a simulator at any stage of your day trading career. Even experienced and professional traders, when they want to develop a new strategy, test it out on a live simulator first. Your focus while reading this book and practicing in simulated accounts should be to develop a strategy worth trading, and it's my pleasure to assist you with that process. Remember, the market is always going to be there. You don't need to rush this. A day trading career is a marathon and not a sprint. It's not about making $50,000 by the end of next week. It's about developing a set of skills that will last a lifetime. Chapter 8. Step by Step to a Successful Trade. Now let's take a look at one of my trades. Later I'll explain in detail how I did it. Building a watch list. On the morning of June 2, 2016, before the market opened, SRPT hit my watch list scanner. It was gapping down 14.5%, had a relatively low float, only 36 million shares, which meant the stock would move a lot intraday, and a high average true range of $1.86, which meant the stock on average moved in a range as large as $1.86 during the day, which is really good for day trading. Trading plan, entry, exit, and stop loss. I looked at the chart and decided to wait and see the price action for 10 minutes at the beginning of trading. When the market opened, I saw that the buyers could not push the price any higher. There was no interest in buying back the stock. Therefore, I decided to do a VWAP trade. I monitored VWAP and price action around VWAP for 2 5-minute candlesticks. I realized that the sellers were in control and that the buyers could not push the price higher than VWAP and hold it. I knew it must be a good short with a stop above VWAP. Execution. After 10 minutes, when SRPT closed below VWAP, I entered the trade by shorting stock around $18.20 with a stop loss in mind just above VWAP. As expected, the sellers took control, and the stock price tanked to $17. I exited when a new 5-minute chart made a new high. When the candlestick made a new high, it meant that the buyers were then gaining control. I covered my shorts at around $17.40 and locked in a $650 profit. How did I do it? My philosophy in trading is that you need to master only a few solid setups to be consistently profitable. In fact, having a simple trading method consisting of a few minimal setups will help to reduce confusion and stress and allow you to concentrate more on the psychological aspect of trading, which is truly what separates the winners from the losers. Now that you have learned the basics of a few trading strategies, let's review the actual process of planning and making a trade. You now understand the setup you want to trade, but as a beginner trader, you will have a hard time planning and initiating a trade beforehand. It is very common to have a good setup, but then enter or exit a trade at the wrong times and lose money while everyone else is making money. I believe the solution lies in developing a process for your trading. Plan a trade, and trade a plan. I have a PhD in chemical engineering, so I firmly believe in the process approach to trading. I can safely say that this is a major reason for my success. My trading process looks like this. Morning routine. Develop watch list. Organize a trade plan. Initiate the trade according to plan. Execute the trade according to plan. Journaling and reflection. You must remember that what makes a trade profitable is the correct execution of all of the steps in the above process. Write down your reasons for entering and exiting every trade. Everyone can read this book or dozens of other books, but only a few people have the discipline to execute correctly. You might have a good setup but select a wrong stock to trade, such as a stock that is being manipulated by computers and institutional traders. Perhaps you will find a proper stock to trade, but you will enter the trade at the wrong time. A bad entry will make a mess of your plan and you will eventually lose your money. You can find a good stock to trade and enter a trade correctly, but if you don't exit properly, you will turn a winning trade into a losing one. All of the steps of the process are important. Think about something significant that you do frequently in your life, and then think of how it can best be done. Now, consider how you do it currently. This is a great thought process for traders to have. When you take a trade, you need to ensure that you are focused on the right things both prior to entering it as well as during the trade. Creating a system for this thought process will take away most of the emotional hang-ups traders experience when looking to enter into a trade as well as managing it while they are in it. This brings you to my final rule. Rule 11: profitable trading does not involve emotion. If you are an emotional trader, you will lose your money. Education and practice give you a perspective of what matters in trading, how you trade, and how you can grow and develop your skills. Once you have a perspective on what matters, you can proceed to identify the specific processes on which to focus. The key to success is knowing your exact processes. Often you will learn them the hard way by losing money. I have found that trading, sticking to my plan and the discipline inherent in my trading methodology have had a snowball effect of positive habits in my life in general, and these habits have contributed to even more trading success. For example, I start my trading process by following the same routine when I get up in the morning. I always go for a morning run before the trading session starts. As mentioned before, I live in Vancouver, Canada, and the market opens at 6:30 a.m., my time. I wake up at 5 a.m. every morning. I go for a run from 5 to 5:45 a.m., usually between 7 and 10 kilometers, or around 4 to 6 miles. I come home, take a shower, and at 6 a.m. start developing my plan. I have found that when my body has not been active prior to trading, I will make poor decisions. There are scientific studies showing that aerobic exercise has a positive effect on the decision-making process. People who regularly participate in an aerobic exercise, such as running for at least 30 minutes, have higher scores on neuropsychological functioning and performance tests that measure such cognitive functions as attentional control, inhibitory control, cognitive flexibility, working memory updating and capacity, and information processing speed. You can easily read about these topics on the internet, or you can email me in our chat room and I will send you some videos and information about these facts. I stopped drinking coffee and alcohol, and I have stopped eating animal-based food, and my performance levels have increased significantly. Not eating meat and fish, any living beings that are marked with blood, and not using alcohol, coffee, tobacco and all other drugs lifts you above the curse and accelerates you forward in every aspect of life. In day trading, simply being better than average is not sufficient. You must be significantly above the crowd to win in day trading. Unfortunately, day trading often appeals to impulsive people, gamblers, and those who feel that the world owes them a living. You cannot be one of them, and you should not act like one of them. You need to start developing the discipline of a winner. Winners think, feel, and act differently than losers. You must look within yourself, discard your illusions, and change your old ways of being, thinking and acting. Change is hard, but if you want to be a successful trader, you must work on changing and developing your personality. To succeed, you will need motivation, knowledge, and discipline. Now, back to trading. As discussed previously, trading cannot be looked at as a hobby. You must approach trading seriously. As such, I wake up at 5 a.m., go for a 30 to 45-minute run, take a shower, get dressed, and eat oatmeal for breakfast prior to firing up my trading station at 6 a.m. I am awake, alert, and motivated when I sit down and start building my watch list. This morning routine has tremendously helped my mental preparation for coming into the market. So, whatever you do, starting the morning out in a similar fashion will pay invaluable dividends. Rolling out of bed and throwing water on your face 15 minutes in advance just does not give you sufficient time to be prepared for the market's opening. Sitting at your computer in your pajamas or underwear does not put you in the right mindset to attack the market. I know, because I have experienced all of these scenarios. My watch list comes from a specific scan that I use every morning. I will not look anywhere else because I am confident that the stocks on that scanner will have the best opportunity to set up for me to trade. I will vet each stock in the same way, using a checklist where I can determine if it is actually tradable for me. My watch list is built by 6:15 a.m., and I will not add anything to it after that time because there won't be enough time to review new stocks and plan for a trade. This allows me to watch the tickers on my watch list for the 15 minutes prior to opening. This actually leads into the next step in my process. During the 15 minutes prior to opening, I watch the tickers on my watch list and develop trade plans for them based on the price action I am seeing. This is the most difficult part, and it requires experience, knowledge, and education. Many traders fail at this step. When the bell rings at 6:30 a.m., 9:30 a.m. New York time, I'll have my plans in place written on note cards, because it is too easy to forget what I've seen on each ticker coming into the open. What is my plan if it sets up to the long side? What's my plan if it sets up to the short side? What setup do I want to see? What are my profit targets? Where will my stop be? Is the profit window large enough for the trade to make sense? Just asking yourself questions like these when you are planning your trades will give you a significant advantage because you can then go in with a battle plan and stick to it. If it is written down close to my face, I can easily refer to it, and that eliminates the anxiety that I used to feel when that bell rang. All I am doing at the opening is looking for my signal and trigger to enter the trade. In the example above, I saw that SRPT had gapped down 15%. I knew that there wasn't much interest in buying the stock. Who would dare to buy when a stock gapped down 15% overnight? Most investors are actually trying to get out and sell before it goes down even further, as though there's something seriously wrong with the company. I could not find any support or resistance nearby, therefore I decided to watch VWAP and chose a VWAP short trade. Once the stock sets up, signals, and triggers an entry, I will enter without question. Well, that's the plan anyway. Sometimes I may second guess myself, but not too often. I have my profit targets written out on my trade plan, as well as the technical level that I am basing my stops on, so after entry, I am just concentrating on hitting my marks and booking profit. There are some that say that knowing when to exit is the hardest part of the trade. It can be extremely tough not to exit the trade too early if you do not have a preset plan. If you have a plan ahead of time and you stick to it, you will have a better chance of letting your winning trades work and cutting your losses off quickly instead of the other way around. This will also help with managing your emotions while in the trade. Recently, I talked to one of my students about filtering out the noise. This strategy goes a long way to help do that, so you can focus on the trade. Once the trade is done, I will reflect on how well my plan worked and how well I stuck to what I had written. Most of the reflection on my trades will come in the evening when I review and recap my trades from the day. I believe one of the key things forgotten by many is reflection. What did I do right? What did I do wrong? And should I have sold earlier? Are all extremely important questions for the development of your trading. Just because you made good profits doesn't mean you are a perfect trader. How you play both sides of the table are extremely important. Write down or do a video recap of the trade and everything that comes to mind lesson-wise, and then file it away with other past lessons, and use them all as a reference for the future. Some lessons hit harder than others, but be confident that with time you will only get better. It only takes one incident of getting your hand slammed in a door to figure out that you must be more careful, but it may take 2 or 3 times to learn to turn on the lights before walking around your house at night. Why is this process in trading important? This process is important because it describes how things are done to prepare for a trade and then provides the focus for executing them. It helps to filter out the emotional social noise and gives you a better chance for a more successful winning trade. It provides you with a tool to go back to and reflect on your trades and makes you a better trader. If you focus on the right processes, in the right way, you can design your way to trading success. Chapter 9. Next steps for beginner traders. Successful day trading is based on 3 important skills. 1. You need to analyze the balance of power between buyers and sellers and bet on the winning group, Chapter 6. 2. You need to practice excellent money and trade management, Chapter 3. 3. And you need sufficient self-discipline to follow your trading plan, to avoid getting overexcited or depressed in the markets, and to resist the temptation to make emotional decisions. Now that you have read this book, you should be in a better position to make a decision on whether or not day trading is right for you. Day trading requires a certain mindset, as well as a discipline and a set of skills that not everyone possesses. Interestingly, most of the traders I know are also poker players. They enjoy speculation and the stimulation that comes from it. Although poker is a type of gambling, day trading is not. Day trading is a science, a skill, and a career, and has nothing to do with gambling. It is the serious business of selling and buying stocks, sometimes in a matter of seconds. You should be able to make decisions fast, with no emotion or hesitation. Doing otherwise results in losing real money. After you've made up your mind and decided that you want to start day trading, the next step is to get a proper education. You should never start your day trading career with real money. Sign up with one of the brokers that provides you with simulated accounts with real market data. Some brokers give you access to delayed market data, but don't use those. You need to make decisions real time. Most of the simulated data software is a paid service, so you need to save some money for that software. DAS Trader, www.dastrader.com, offers simulated accounts for $120 per month. If you use it for 1 year and trade only with simulated money, it will cost you only $1,440. This is the cost of a proper education. If you are seriously considering day trading as a career, it's a small expenditure compared to the cost of an education for a new profession. For example, imagine that you want to go to school to get an MBA. It will easily cost you over $50,000. Likewise, many other diploma or post-graduation programs cost significantly more than the education required for day trading. Once you have a simulated account, you will need to develop your strategy. Try the strategies that I have discussed in this book, and master 1 or 2 of them. VWAP, support or resistance, and reversal strategies are the easiest. You need to only master a few of them to always be profitable in the market. Keep your strategy simple. When you have a solid strategy that you've mastered, make sure there is no emotion attached to it. Practice with the amounts of money that you will be trading in real life. It is easy to buy a position worth $100,000 in a simulated account and watch it lose half of its value in a matter of seconds. But could you tolerate this loss in a real account? If not, you will probably become an emotional trader and make a decision quickly, usually resulting in a major loss. Always trade with the size and position that you will be using in the real account. Otherwise, there is no point in trading in a simulated account. Move to a real account after at least 3 months of training with a simulated account and then start small, with real money. Trade small while you're learning or when you are feeling stressed. If you wish, you can always have a chat with me in our chat room and receive some guidance. Continue your education and reflect upon your trading strategy. Never stop learning about the stock market. It's a dynamic environment and it's constantly changing. Day trading is different than it was 10 years ago, and it will be different in another 10 years. So keep reading and discussing your progress and performance with mentors and other traders. Always think ahead and maintain a progressive attitude. Learn as much as you can, but keep a degree of healthy skepticism about everything, including this book. Ask questions, and do not accept experts at their word. Join a community of traders. Trading alone is very difficult and can be emotionally overwhelming. It is very helpful to join a community of traders so you can ask them questions, talk to them, learn new methods and strategies, get some hints and alerts about the stock market, and also make your own contributions. If you join me, you will see that I often lose money. It can be comforting to see that losing money is not limited to you, and everyone, including experienced traders, has to take a loss. As I've said, it's all part of the process. There are many chat rooms that you can join on the internet. Some of them are free, but most of them charge a fee. By joining our chat room for free, you can see my screen in real time while I am trading and listen as I explain my strategy. You can take trades with me, or just watch and listen. Or you can take your own trades, but still be part of our community. It is extremely important to remember, however, that if you are in any community of traders, either our chat room at www.vancouver-traders.com or the dozens of others out there, you should not follow the pack, but should be an independent thinker. Generally, people change when they join crowds. They become more unquestioning and impulsive, nervously searching for a leader whose trades they can mirror. They react with the crowd instead of using their minds. Chatroom members may catch a few trends together, but they get killed when trends reverse. Never forget that successful traders are independent thinkers. Simply use your judgment to decide when to trade and when not to. Last but not least, if you enjoyed reading this book and found it useful, I would very much appreciate your taking a few minutes to write a review on the Amazon website. The success of a book like this is based on honest reviews, and I will consider your comments in making revisions. If you have any feedback, feel free to send me an email. Your review on Amazon will help other people to make informed decisions about my book. I purposely priced it low so more people would be able to purchase it and use it. Teaching people and helping them to start a new career fulfills something inside of me that motivates me every day, so I hope you can help me to accomplish this task of ongoing learning. If you're ever interested,